Now, what about minority discounts or control premium? Those come up in those cases as well as acquisition cases.
This is another case where, again, it's very contentious and open to debate, interpretation, and so on. Control premiums emerge when the full business is being sold. So for an example, most recently Bank of America bought Fleet. Now this is not a private transaction, but you could see this in the public markets. And Bank of America paid a 40% premium to Fleet. That is, they paid 40% more than Fleet shares were trading at prior to the announcement of the acquisition. Now, why did that 40% premium emerge? Now, there are probably a variety of reasons for it, and we probably need not go into that now, but there are a lot of transactions both in the public and private markets that have this premium. Now, you might ask yourself the question, why do they emerge? Like, why would somebody pay more for the cash flows than, quote, they're worth? And the reason is because when a company is transacted completely, not partially, completely, that essentially what's happening is that the assets are moving to somebody else, and they have now the control over those assets. So there's certain options that become available to the new owner that maybe the seller hadn't exercised. And to get control of those assets and those embedded options, as we would say in finance, they might pay a premium. And of course, the question is, you can theoretically articulate that they might pay a premium. The question, of course, becomes how much. And again, that is a very, very technical. I can't do this actually easily in this kind of presentation, but I can tell you that there's a lot of technical, complex finance that's involved in actually calculating that. But that aside, the difference between a control transaction where the full company is being sold and a minority transaction where less than control is being sold results in value differences. Namely, minority shares are always worth less than control shares. Minority shares are transacted typically in a public market. When you buy shares of IBM, you buy one share, you buy a minority interest. If you buy 5% of a particular company, private company for an example, that's a minority interest. If you bought 51% of a private company, you would effectively be getting controlling interest. And the controlling interest, and this is why it's worth more, gives you the right not only to the cash flows that are currently generated by the business, but it gives you the right to do something else with the assets, to re-engineer them, redeploy them, make decisions about the business that a minority shareholder could not make, and therefore control is worth more than minority value.
So we have those elements. We have the cash flows, we have the growth, we have the rate of return, we now look at liquidity, we look at control depending on the application. So these are the key concepts. Now, as our audience members would be looking at a valuation report, perhaps done for their clients by an independent party, what kinds of things should they be looking for in that kind of report so they can advise their clients as to whether they feel that all the steps that were taken in that valuation were done appropriately?
Well, I think the first place to look is Revenue Ruling 5960, which identifies what should be included in a valuation report. But in short, what should be included is the nature of what's being valued, typically if it's a business, whether it's a minority interest or a controlling interest. You need a pretty good assessment of the economy moving forward, a very good assessment of the industry that the firm operates in. You need to be able to identify the cost of capital for the firm. And of course, there are multiple valuation methods that you can use. And there are 4 or 5 methods that the IRS has anointed as methods that are officially okay. And they are basically income methods like discounted free cash flow or comparable methods like the multiple method, for example. There's also something called excess earnings, which is an income type method, and there's, of course, valuation of the underlying assets themselves. So there are a variety of things you can do, but the things to look for are, in summary, you should look for a macro write-up, macroeconomic write-up, industry write-up, very detailed on the industry and cost of capital. You should also look for that there should be more than one method used. And there's also typically, if more than one method is used, there's typically more than one answer, each method giving you somewhat of a different answer. You should look at how the valuator has weighted these different estimates and see whether it makes sense. In some cases, there are certain methods that are weighted more heavily than others, and you should understand why that's the case. I would say in general at Axiom, and I think others, valuation firms as well, use discounted free cash flow as always a primary method. And the reason we use it as the primary method, not the only method, but the primary method, is because academic research has indicated it's the most accurate. Because it's the most accurate because it requires the most input from the analyst. So it's not a multiple or comparable method. I'm not looking at the book value of assets. I'm actually looking at the ingredients that create value for the owners of the firm in terms of the products and services the firm sells and how efficiently they produce it and distribute it.
What would you look for in terms of the credentials in terms of who did the report, and how do you evaluate those?
Well, there are credentialing organizations for business valuation. You cannot get a PhD in business valuation. You could get a PhD in finance with an expertise in corporate valuation, and I would say in the pecking order of things, that would be the highest, if you will, having experience at the academic level. And I say this predominantly because so much of the work in the business valuation world is depending more and more on academic research and the models and theories and statistical analysis they use. And as a PhD, you have that kind of background. So I think that's very, very important. Now, that being said, there are accrediting organizations for people that don't have PhDs, that people who have other degrees. So for an example, if you have a CPA, AI CPA offers what's called a CVA, a Certified Valuation Analyst. And essentially what that is, it's a professional certification, and you usually have about 8 hours worth of coursework, and you have to produce a report. It's equivalent to, and this is not depreciating it in any way, but it's equivalent to taking perhaps one course in corporate finance, advanced corporate finance at the undergraduate level at a college. It provides you with the basic ingredients you need in order to do evaluation, but it doesn't provide you with all the tools and background you would need to do what we would consider complex valuations. So they are recognized. These professional certifications are recognized by the courts. They're recognized by the IRS. And so they are at least if you're going into this business, you need to at least to have that. If you are giving testimony in federal court as an expert, then I think there you have to meet the standard of Daubert. And Daubert actually has very specific standards as to what an expert is. But generally an expert is one who has education and training in the area that he's expert in, written some minimal amount, but certainly has written and done research in the area. So it actually raises the expert to a higher standard. Typically in a state court, if you're providing valuation-related information or analysis, the Daubert standard is a standard that it may not be applied, that simply having a CVA or being accredited by another organization, a business valuation organization, is certainly good enough.